Hi, folks. Let's talk about the basics of trading. Join me. Hi, folks. So, welcome to the podcast, The Way I See It, which is just my podcast on money, personal finance, the economy, even politics, and how they all intersect and what we can learn from all that. Yeah. This week, I want to talk about trading, the how to trade per se, not really the what to trade, but how to trade. I do get a lot of comments. People call me up and say, hey, I want to buy this, or what should I buy? And I get a sense that people aren't really understanding or don't have a real understanding of how trading in financial instruments should take place. So this is just my way of plugging that knowledge gap. Yeah. So the first thing you have to understand in trading is this: you have to have discipline and you have to have knowledge, and you have to have both of them. You can't be a successful trader if you don't have knowledge of financial markets, if you don't watch the news, if you don't understand politics and how politics bleeds into financial markets. You have to understand all that. If the ECB says something, what does it mean to your position? You have to really understand what happens with all those transactions and all that news that you see every day. Yeah. The second thing you need is discipline. You need discipline to say, hey, if I've made profit, I have to pull out, or I'm not going to go into this trade because I don't understand it. So discipline and knowledge are really what you need to become a very, very good trader. It sounds simple, but many people do not follow these simple laws. You have to have discipline. You have to have knowledge. So we'll put that out the way. Those are, like I said, the traits that make a successful trader. Let's now talk about the how to trade. So I have a few steps I've written out, and you can take notes and go with me. I'm trying to go very slow this week. Yeah. The first thing you do when you want to trade is you want to determine the asset class that you want to trade in. Like we know in financial markets, you can trade anything. If you want to trade bonds, equities, commodities, power, you can trade really anything. There can be a price quoted to you to buy or to sell. So you want to say, okay, if I want to trade currency, yes, that's where I want to focus on. You can have two asset classes, but you want to first determine this is the market I want to play in. And that market should be a market that you understand. Or if you don't understand, you want to make the effort to really understand the nuts and bolts of how that market operates. If you don't understand the market, then you cannot trade in the market successfully. Yeah. The second thing you want to understand is now, what's my budget for trading? Remember that we're talking about trading now, not long-term investing. We're talking about buying and selling. You can make 100% profit, or you could lose your entire principal. Because there's a considerable risk that you can lose your principal, you want to establish how much can you lose and still pay your rent. Literally, that's the question. How much of your income can you set aside for trading that if you lose it, you can still meet your non-discretionary expenses like rent, like food, like school fees. So you don't want to trade with the money you set aside to take your kids to school. You don't want to touch that money. You want to say, okay, can I take some money aside and say I'm going to trade with this, with the in the back of your mind saying, hey, if I do lose this money, it's not going to be fatal for me. So that's the second point. Determine the market you're trading and determine your budget. And that budget has got to be funds that you can lose, sorry to say, without it affecting your ability to survive the next day. The next thing you want to talk about now is your lot size, or should we say your minimum trading volume in terms of the dollar or naira that you want to trade in. You want to establish how much you want to go into the market every time you trade. You simply can't just trade any currency, any amount that you see. You want to say, okay, every time I trade, I want to trade with this minimum dollar amount, or that minimum dollar amount. You want to establish that minimum trade, yeah? And more or less the market that you choose will determine that trade for you. For instance, if you were doing currency markets, then of course you've got the micro, the mini, and then the standard lot size. That means that your minimum that you're going to trade in the currency market is going to be like either $1,000 or so. That's going to be your minimum, because that's the micro lot that you can invest in. But if you are buying, say, equities, it's possible to buy equities just one unit. And equities differ in price, So you can say, okay, I want to trade, say, $100 or $200, and that's going to be my minimum lot size, yeah? So first of all, you establish the market you want to trade in, then you determine the budget, the overall budget that you're going to use to trade in. Then you determine your lot size, which means every time I go into the market, I'm investing this minimum quantity. And that's basically what your lot size then establishes, yeah? The next thing you want to do is establish your entry and your exit criteria. At what point do you enter the market to make a trade? This is very important. In trading, the profit is made when you buy. The point is, when you buy a good stock at a low price, you are guaranteed to make money, because once the market recovers, you are already in the black. You've made the money. But if you buy a good stock at a very, very high price, then you are chasing the market. You're hoping the market just does very, very good that year, or boasts one very, very good dividend for you to make your money back. So the price at which you enter is very, very important. Not just the price, but also the volume. There's no point in you buying a good stock at a good price, but with low volume, which means you're holding a very, very good stock, but you can't sell it because no one wants to buy it from you. So the price you go in, the volume you go in, this now determines your entry point. How do you determine what point to enter? Do you want to look at the highest and lowest price for the 2-week period? Don't look at the moving day averages. These are all what you want to look at. So you then have your own criteria and say, okay, if a stock has fallen and is trading as below its 52-week price for, say, 3 weeks or 4 weeks, I'm going to buy that stock. Just an example. So you want to have a criteria, a disciplined way of entering into a position. That's what you want to determine. You want to write that down. You want to say, this is my criteria that I'm going to use before I go into any position. Yeah. What about exit? When do you exit a stock position or a currency position? At what percentage profit? 2%, 10%, 25%? You also have got to make this known. You have to say, if I hit this percentage profit, even though the market is going up, I'm going to pull out and take out my principal and say, yes, I've done that trade, I've unwound it, and I've made my profit. This is where most traders get it wrong, because when you go in and the market is rising, they're like, I'm just going to ride the market. And when you're riding the market might fall below you and you want to get out and you have no volume to get out, and you just fall with that stock or with that currency pair. So it's very important that you determine what triggers you to go into the trade, or what triggers you to go into the market to buy with your minimum lot size, and also what is going to trigger you to sell. If you're an aggressive trader, you might say, okay, I'm going to ride the market till I get to 25% before I exit. But if you're like a conservative, you can say, hey, I'm going to ride till 10% before I exit. But the point is, whatever you determine that's going to be your entry and exit point, stick to it. That's where the discipline comes into the market. Go in, make the profit, then you come out. Very, very important. Yeah. Now, next we'll talk about is now opening up the account. You now open up the account only after you have done all this. You have determined the market you want to play in. If you're going to play currency market, then the market or the account you're going to open will differ from if you are playing, say, the Bitcoin market or the FTX market. So the trades you want to do determine the kind of market or the providers that you basically go for. Are you going to use a human broker or an online broker, or even a fintech guy? So that determines the sort of brokerage that you would basically sign up with. And it's important that you go to a brokerage that is not too complicated for you. I mean, if you can talk to a human better, get a human broker. If you are more tech savvy, then get a fintech. Go to what favors you. Go to how you can interact and you can discuss and you can get more knowledge. If it's fintech and IT doesn't favor you, talk to a human. Yeah, you have to be comfortable, learn it. Yeah, before you then go out and just copy the crowd and then get an online account and you're online and you don't understand what's going on. Lots of figures showing up in your face and you don't know really what's happening. Yeah. So now that's where we then come to the point of discussion now. Entering and exiting. Let's go back to that. When you now have established that you were going to enter a trade, when it's at, say, 2-week low, for instance, when you buy, you have to buy insurance as you are buying. So if, for instance, I buy Bitcoin at say $22,000 for one, I would immediately buy a stop loss when I'm buying a purchase, and I'll say, hey, if Bitcoin falls to say 21, say 500, so if Bitcoin is $500, sell my position. Or if Bitcoin falls to say 2%, which is going to be about 21,560, sell my position. So what am I doing? I'm setting a bar that my losses can never be more than 2%, even when I enter. So when I've established my entry criteria, and I say, for instance, my entry criteria is if the market volume is low and the stock price has not been trading, so it's trading below its 1 year average, for instance, and I go into that position, I'm also going to buy insurance in that position by saying I'm going to set a stop loss and say, hey, if I'm in this position and the share starts to fall and it falls below this level, sell my stocks. If you have a fintech app that you're using, you can set that up. If you have a broker, you have to make sure you write that to them and make it very, very clear. Sell my position. You don't have to call me once it gets to this level. So you put an insurance policy, you put a floor supporting your losses to say, hey, I will not lose more than 2% or 3% of this position. Now, if you're aggressive, you can extend that stop loss to say 5% or 10%, i.e. to say the stock has to fall 5% or 10% before it triggers my stop loss. But if you're aggressive, you can say, yeah, if it let it fall, it's going to recover. I'm in the market for a long term. But if you're conservative, once it falls 1%, 2%, sell the position. What this does for you is to say, even if the market crashes, you're not going to basically fall to zeros. You have that insurance policy you bought that's going to basically sell your equity. Yes, you lose money, but you're only going to lose 2% of that principal that you've put in. Yeah. So the same thing with when you're exiting. If your exit hits so price, you want to exit. So you can set this up basically when you are entering. You can say, once I take a position, I put a stop loss and I put an upper range, and I say I'm going to sell that upper range. And then basically it's autopilot because you've done your homework and you said this stock, in my view, is undervalued as regards its intrinsic price. So you said, hey, I think this stock is undervalued. I'm going to go into it. But once I buy a stock price at 10 Naira, I'm going to put a stop loss at 8 Naira, and I'm going to put an upper cap at 25 Naira, which means when the stock gets to 25 Naira, whatever happens, I'm going to sell and exit. But if the stock falls to 8 Naira, whatever happens, I'm going to sell. So you've stopped your losses at, say, 2%, and you've capped your gains at, say, 25%. You can choose what band fits you, but the more conservative you are, your bands are going to be smaller. So you're going to have a lower stop loss and a much lower upper limit for you. But if you're more aggressive, you can say, hey, no, let it ride. I'm going to go up to 40% over the stock, and I'm going to allow the stock to fall to 10% because I know it's going to come back. So this is basically how you set up your trade. And you basically just do rinse and repeat. Remember, we've not talked about what stocks you're going to buy or what currencies or what the currency pairs or what assets you're going to buy. I'm just trying to detail to you how you want to set out your trading day. You can do this every day or every week. So basically, let's go back and do a summary. The first thing you do, you want to determine the assets that you want to trade in. And those should be assets that you know that you're comfortable with. Then, of course, you want to get a budget. How much you want to trade with? Is it weekly? Is it daily? Is it monthly? Even annually? What's your budget for trading? These are funds that you can lose and you will not affect your meeting your non-discretionary expenses like rent. After, you want to talk about your frequency. How long or how often will you trade? Are you going to trade weekly or monthly? And of course, what's going to be your minimum lot size to invest in? And like we said, the market you are in is going to determine your lot size. So if you're doing currencies, clearly your lot size minimum is going to be $1,000 because that's the smallest unit that you can buy in currencies. Then want to establish your entry and your exit criteria. At what triggers you to buy, what triggers you to sell. Very important you get that down and you stick with it. Then once then open up an account that matches with the asset classes that we want to trade in. I mean, if we're doing Bitcoin, it's clear that we're going to have to go online to trade Bitcoin rather than talk to a person. But if we're doing equities, you can say, okay, I'm going to do a hybrid. I can do a human, I can do a machine. So that's basically what you want to find out. What suits you? How can you communicate better? Where do you get the best service? Then after we've chosen our market, we then want to enter the trade. And as we enter the trade, we're buying insurance to ensure that even if we lose, our trade is misguided and if we start to lose money, we don't lose all our principal. We don't lose, say, 2% or 3%, as the case may be. Same thing, when we hit our profit, we're taking our profit, irrespective of where the market is going to. Once we hit our set profits, we're leaving the market and taking our profits and going home. Again, remember, guys, this is trading. This is not fundamental analysis. This is not long-term trade, long-term investing. This is you're trying to be a day trader or a week trader. You're trying to go in and come out. We're not looking too much at the fundamentals. We're looking at the price movements. We're not trying to say which stock is the best stock. We're trying to find out which stock our neighbor thinks is the best stock. If we know what the market is buying, then we buy with the market and then we exit. All right, guys, we'll leave it up here for today. Thank you all for listening. We've got a lot of downloads. I thank you guys. Yeah. Keep talking about the podcast, the way I see it. Invite your friends, tell your neighbors. Yeah. Follow us also on Twitter, FinPlanCarlo@1. I appreciate you guys, and I will see you all next week. Thank you so much.